Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs.
And I'm Tyler Warner, a small business owner with a lot of accounting questions.
And so today we're going to be talking about taxes, ins and outs of personal tax returns and kind of how all that works.
Good deal. Before we do that, we got a review in. You want to
let's
read
get
it for
into
us?
it. Yeah, let me pull it up here. All right, so 5-star review, that's key.
Awesome.
It says here, it counts, exclamation point. Don't want to leave that out. This podcast is so excellent at laying the foundation of useful knowledge for the entrepreneurial small business owner and even individuals to help make informed decisions and help to make it count. I'm down for the count. The count was in air quotes. You can't see that.
Nice.
That's from Scott Scarano, admittedly a buddy of mine. Thanks,
Yeah.
Scott. Appreciate the love.
Nice, man. Yeah, that's a good review.
That's
We
good
appreciate
review.
it. Yeah.
First of many, we hope.
That's right. A lot of pressure now to live up to that glowing review.
5-star. We got all
Exactly.
5 stars.
Yeah, I feel like everything that comes out, is this a 5-star question? You know?
Or response.
Yeah, right.
Is it a 5-star response?
Yeah. So to that end, let's get straight to it, man. What I feel very qualified in terms of being the guy who doesn't understand much about taxes.
Right.
So before we were talking, and you were kind of drilling me to kind of test my knowledge, and
That's
really
right.
the only reason I survived that quiz was because of things you've told me recently that took years for me to
Right.
stumble upon.
Yep.
So hopefully we can save other business owners years of confusion. And
Yeah, because what we're going to get into help a lot of people. What we're doing here today is not meant for you to be the tax expert, but it's just meant for you when you're making decisions, you're in conversation with other people, just to have a working knowledge of how these things work, a general knowledge. So because there are so many misconceptions with taxes specifically and questions I get. And so that's really the genesis of what we're doing here today is like, let's give people some facts, some meat on the bone there to make some decisions and understand this stuff.
yeah. So what's the first one, the go-to question that you feel like you get the most of the
Yeah,
time?
question I get a ton is, Marcus, it's about tax brackets. So let me set kind of the background. It's about income tax brackets. All right, so let's just give a little 10-second background on tax brackets. If you're married filing jointly, so you're married and you don't file separately, you file a joint tax return with your spouse. Let's just give an example. The 22 or the 24% tax bracket starts at taxable income. It's not this exact number. It's $171,000 roughly. It's $171,051. Okay. The question I get is, Marcus, last year I made $160. I know the 24% tax bracket starts at $171 and some change. If I make $180, is that a good thing? Like I always hear this, I'm going to be in another tax bracket. And what's behind that question is they think the minute they cross over that threshold, it's like a cliff.
So like 51 cents.
The minute they make $1 over 171,051 of taxable income, everything's taxed at 24%. And you'll hear people say stuff like, man, I don't want to make any more money. And generally speaking, there's caveats, but I would say you always want to make more money. Only thing that happens in that example is every dollar, just the dollars over 171,051 are taxed at 24%. So just a 2% bump. Not just, it's an increase in taxes. Nobody likes that. I get that. But the point is, it's just the higher tax rate is just on the marginal amount, the amount in excess over the tax bracket.
Right.
So a question I get a ton, right? And so just wanted to give a little bit of clarification about that. Obviously, you can look these things up. You can start to understand where you fall in these areas. Mm-hmm. But suffice to say, just start to understand that the tax system is progressive. Let me give you another example. You've got 10, 12, 22, 24, on and on and on. You work through those brackets. So the 10% brackets from 0 to 19,750, you pay tax 10% on just that income. Once you exceed that amount, it's like 20 grand to 80 grand. That's at 12%, and so on and so forth. So you just pay the percentage on that slice of your income. It's a progressive tax system.
Okay.
So again, this question I get a lot. Wanted to give some clarification on that.
Gotcha. And that's been like that forever?
Yeah, absolutely. Yeah,
Okay.
I haven't known. I think taxes since I can't speak to when they started, but I would think historically speaking, this has always been the case. It's a progressive tax system.
Gotcha.
It's not a cliff. You don't all of a sudden fall off and everything's taxed at one rate. It's always progressive.
Okay. So while the bracket nuances might change
Yeah.
every year,
For
is it-
inflation. They generally
okay.
change with inflation.
Okay.
So they're set by Congress. And you hear like when Trump came in 2018, Tax Cuts and Job Act, that changed a lot of the rates. But ultimately, the brackets to which those rates are applied change with inflation every year. That's why earlier I gave the example of $171,051. You wouldn't normally do that, right? You would use a round number, but it's adjusted every year for inflation.
Okay. Gotcha.
Yeah.
All right. That clears that up, I think.
All right. So a couple other things. Let's talk about, and I want, and a lot of what I want to do here is to kind of get your thoughts on some things, and you jump in where it's like, okay, wait, what the heck are we talking about? Okay. The differences between ordinary income and capital gains. So I'll ask you a question. What's the difference between ordinary income and capital gains?
All right. Ordinary income, outside of like W-2, right? If you're so that seems like ordinary income.
I'm asking you.
Ordinary all-American income. Yeah. It just seems like anything you make is income, right? That's ordinary.
Generally speaking, yes.
Right. So like not like if you own stocks or if you own like your anything in your IRA or
Right. Well,
so
that's actually ordinary income.
Oh.
I know it's confusing.
All right. So I guess anything stocks or securities.
Yes.
And then maybe real estate, and then sometimes, like I guess, depending on how you've structured your business.
This is why we have a business. Like just looking at your face as you bring as you bring up the different things, like maybe a business. Yeah. So you're hitting on the right
for
point.
not just leaving me there for another 5 minutes. Just
The reason I asked you is because
and such as
the reason I asked you is because it makes the point. The stuff's difficult. Like,
right.
Okay, so capital gains, generally speaking, are on investments. So we won't get into every nuance,
Sure.
but generally the tax code gives preferential treatment to investment. The reason they do that is just because it's historically been meant to spur economic growth. They want people to put their capital at risk and give you a
Right.
preferential rate. So capital gains are, let's give an example. You buy a share of stock, you buy, let's say Tesla, you put 10 grand in Tesla, it goes up to 15,000. You sell it after holding it a year. That's key. You hold it a year, you sell it for 15,000. You have a $5,000 capital gain. In that example, because you held it for more than a year, it's a long-term capital gain, and you pay a different rate than ordinary income. Ordinary income
Gotcha.
goes back to those tax brackets we talked about.
Gotcha. So in that same scenario, if I had held it 11 months, it would have been ordinary income.
Because a short-term capital gain reverts back to ordinary income rates.
Okay.
So, just a question I get a lot, differences between the two. Generally speaking, you can kind of think investment, basically the amount you bought something, the difference between what you sell it for and what you buy it for. We're not going to talk about depreciation, but the difference between the cost of it and what you sell it for is generally a capital gain on the investment. Think real estate, art, stocks, bonds, and this now cryptocurrency, businesses to a certain extent. There's some caveats. Ton of it, but you get the point.
Yeah. So, I mean, I feel like every business owner would feel like their own business is an investment.
Right.
I mean, I get that it's semantics, but what is the difference if that's not too convoluted?
It's pretty technical, but I'll just give you a quick example. If you own a business, it depends how it's structured.
Okay.
So if you own a business that's an S corporation, if you sell it, capital gains. If you sell a partnership interest, which most people don't realize their LLC is taxed as a partnership, you could have all ordinary income. So I won't get into all those details, but just suffice to say, if you have a business and you're thinking about selling, you need to understand that. You need to talk with somebody.
Yeah. You mentioned a little bit about LLCs or whatever. I know we talked a little bit about this. It finally clicked for me after a while of like, we would do a personal return, but we would also have a business, I guess return might be the name for it.
Yep.
But we would only pay one check to the IRS as and it took me a while to not understand, like, okay, well, what is, my wife owns a business. So like, what does she own taxes? What do I own taxes? What we couldn't quite understand until finally you're like, no, this is how it works.
Yeah.
Maybe explain that to people.
Yeah, so what you're talking about are flow-through entities. So let's contrast flow-through entities with entities that aren't flow-through. So, flow-through entities are S-corps, partnerships. I think that's it, yeah. S-corps and partnerships. Okay. A C corporation. So think of a C corporation. That's most people do not own a C corporation. They're generally now, there's reasons why you would have a C corp, but most of the time a C corp is a thing like a publicly traded company.
Gotcha.
So they have double taxation. When you get a dividend from Tesla, right, you pay tax on it, but Tesla also pays tax on the earnings, double taxation. So most small business owners don't have a C corp. So let's throw that out to the side.
Sure.
S corps and partnerships. Let's even go back a little bit further and talk about LLCs. The question I get a ton, LLCs, how am I going to be taxed? And the answer I say is, I don't know. There is no LLC tax return. There's no place in the tax code where you say, I have an LLC, how is it taxed? What happens is you have to understand the default tax treatment of LLCs. So a single member LLC owners are called members. A single member LLC is by default in the tax world a disregarded entity. Okay, so I don't know.
Yeah.
Let's get into. We're going to get kind of in all that. Okay, disregarded entity. If you form Tyler Werner LLC tomorrow without any elections to be taxed as anything else, you will be a sole proprietorship, which means you file a Schedule C on your personal tax return. You don't have to file a separate tax return for that business. The income and expenses go on your personal tax return on a separate schedule. Okay, but you could elect to say, hey, I want Tyler Werner LLC to be taxed as an S corporation. And now this is going to get into your question. Okay. If you're an S corporation, to your point, the S corporation doesn't pay any income tax. What it does is it files its own separate tax return. Again, contrast that to a disregarded entity, which doesn't have its own tax return. Files its own tax return, and then gives the owners, in this case, you would be 100% owner, a Form K-1. It says, Tyler, this is your share of the earnings of this business, which is 100%. Pick that income up or report it on your personal tax return. Hence the flow-through concept.
Okay.
So that's what when you're talking about you and your wife's business, you guys each have S corporations. And so the S corps, while they file a tax return and report the income, they don't pay the tax on the income. It flows through to you personally to be reconciled on your personal tax return and tax calculated there.
Right. Yeah. And every year, right?
Every year. Yeah. Yeah. There's just, I mean, I think that's, you're asking a really good question. Another question I get, just kind of down the road of tax entities, the question I get is, I formed an LLC, I can write more stuff off, right? And the answer is generally no, because back to the original point, an LLC that is only one member is a disregarded entity. So by default, the IRS doesn't even regard your LLC. My point is that you as a sole proprietor and you as an LLC sole proprietor are the same thing. The deductions don't change.
Right. But to be fair, if you buy things within that LLC, they are not their expenses that
they are, but they would be deductible if you bought them as Tyler Werner, operating a sole proprietorship without an LLC.
Gotcha.
That's the point.
Okay.
And so because, again, you as an LLC are disregarded, it's like you are doing business as yourself anyway.
Okay.
So no difference when you form that LLC.
So
I just
it's
want to make
not
that point.
like they don't recognize you have a business. They just
Correct.
don't recognize that it's anything different than
you
if
personally.
You're just being
Now you still have
themselves.
some state legal protection. I mean, I'm not an attorney, but I think everybody knows you form an LLC generally for lots of reasons. One being legal protection of your assets and all that kind of stuff.
Yeah, I think taking a hint from the name, it's limiting your liability, not necessarily your tax burden or anything like that.
Yep.
Why is that confusing for people? I know, I'll say why it was confusing for me. I think because as a business owner, you do pay taxes for payroll at every level, federal and state. And in retail, you pay sales tax literally every, and that's a mess and a whole other thing. But so you do pay taxes as a business. Am I still saying that wrong, or is
no?
that
You're right. We're talking about income tax.
Gotcha.
Yeah. So if you have employees in your business, whether that's a sole proprietorship, an S corp, a partnership, obviously you still have to withhold income taxes. You have to withhold Social Security. You have to match Social Security and Medicare. Yeah. So we're just talking about the income tax, but it does trip up a lot of people. They're like again, back to your point, you have the best scenario where you kept mentioning like, wait, why aren't we paying taxes? We made X amount of dollars. And it's like, well, you are ultimately when we file your personal tax return. And it's the reason why you can't do your personal tax return until you have your K1s. I mentioned K1s earlier from
Right.
any flow through entity you're a member, you're an owner of.
Right.
So that trips up a lot of people too.
Yeah. Gotcha. What else people scratch their heads with?
Let's see here. I've got a little list. Okay, itemized deductions versus standard deduction. All right, so let's kind of bounce.
This is one I got right.
I think you did get this right.
Yeah.
Yeah. You did get this right. Yeah, but you've been taught well.
Yeah, I've been.
You've been coached somewhat. All right, so itemized deduction versus standard deduction. Now we're talking personal. So itemized deduction being things like your charitable deductions, your mortgage interest, your property taxes, your income taxes that you pay, whether through your paycheck, all those things. So what happens is when you file your personal tax return, the government says, federal government says you get the greater of the sum of all of those things, charitable, mortgage interest, property tax, state and local tax, and there's some caps on those things, but generally either that or a standard deduction, which is just a deduction they give to you. Meaning this year, a married couple, so you and your wife, if you had no house without a mortgage and you didn't pay state income tax, the government would give you a $24,800 deduction. The reason that's relevant is because a lot of times people think, hey, I gave a ton to charity this year. Like, I say ton, relatively speaking, to them, 10 grand. And I'll say, man, it didn't give you, and they're expecting when they file their tax return because they don't know how things work. Oh, I'm gonna get a lot of money back this year. I got a bunch of deductions. I would say it didn't even benefit you. You had the standard deduction was greater than your charitable of 10,000 and your mortgage interest of 8 grand. That's only 18. The standard deduction is 24.8.
Right.
So kind of why I wanted to mention this to people is just so they start to think what happens in the tax world in terms of people dealing with us is expectations. And people get unrealistic expectations or misinformed expectations. Like that example, I gave a bunch of charity. Oh, I know my tax bill is going to be less. Might not be.
Right.
You might not even get a benefit from it. That doesn't say you shouldn't be charitable, but it says you should be charitable maybe in a different way. Maybe you give all of your charitable donations for 2 years in one, and you do it every other year. Like there's strategies to this kind of stuff. But the point is, you need to have at least an understanding what is an itemized deduction and how does a standard deduction come into play, because it could affect your expectation of what your tax return is ultimately
Right.
going to look like.
Yeah, that makes sense. I mean, how often does that change? Like,
Yeah, so 2 years ago, back with the Trump tax cuts, the Tax Cuts and Jobs Act, the standard deduction basically doubled. So it used to be around 12,000. Now it's 24.8. Again, it goes up for inflation. But as far as I had ever done taxes, which I've been doing this since in college, since 2002, it was always around 12,000. I think 11.8, 11.6, and so on and so forth. So that's a big thing people don't understand. I hear them mixing concepts of where things are deducted, and it's just a good thing to understand,
Yeah.
like itemized deduction versus the standard.
I don't know if it's on your list, but that we can. This question may dive us into credits versus deductions in general.
Yep.
But how often do not the standard deduction amount vary, but what is included as maybe an itemized?
Okay.
Does that ever vary?
Not really.
Okay.
So the only thing that changed, that's a good question.
Like one day it's not gonna be like, oh, if you buy,
Yeah,
groceries, it's
correct. Well, it does. Okay, so let me back up a little bit. As long as I've been doing taxes, yeah, there have been minor changes. Like it's always been mortgage interest, charitable. I didn't mention medical, but most people don't get medical because medical has to exceed a certain % of your income before it even gets thrown into that pot of itemized. Okay. Mortgage interest, charitable, state taxes, medical. That's generally been. There's a few other ones. But you also used to have what's called miscellaneous itemized deductions, which were things like if you worked for somebody and you didn't get reimbursed, so unreimbursed employee business expenses, like you're in sales and you drive a lot and they don't reimburse you, that used to be deductible. That changed where, again, with the Tax Cuts and Jobs Act, kind of a give and a take in Congress. They lowered all the tax rates, but they took away certain deductions, and that was one of them, miscellaneous itemized deductions. So to your question, that's the biggest change I've seen. Used to be able to deduct the fee you would pay your tax preparer. You can't anymore. That was a miscellaneous itemized deduction. Your safety deposit box. I mean, again, nobody does that, but
Gotcha.
but they haven't changed much.
And these seem Like pretty minor.
Miscellaneous.
Yeah.
The biggest one being the unreimbursed employee business expenses. Typically, the biggest, that's big for people in sales.
Yeah. Yeah, I don't know. I mean, I feel like there's like this kind of myth that CPAs kind of secretly know all these, these areas of deductions that we just don't know about,
Right.
But my experience is that they're every year pretty much the same.
They are. I mean, every once in a while, just through tax policy, you get things like right now you have the qualified business income deduction. That's not a standard deduction or itemized. That's just a whole new thing. Or domestic producers. I mean, yes, they're for the most part things are the same, but every once in a while through tax lobby and negotiations in Congress, there'll be these new programs that come
Right.
about. Like the qualified business income, that came about when the Tax Cuts and Jobs Act came out. That was, but also they said, okay, we're going to give you this deduction. We're taking away the miscellaneous itemized deductions. Kind of give and take.
Gotcha.
Yeah.
All right, well, let's move on to credits and deductions.
All right. So kind of let's go back to where you and I started.
Mm-hmm.
What is it like? Let's kind of let's get the layman's term, and I'll see where you stand on it.
I'm pretty proud of this one based on your reaction.
I liked your analogy.
Yeah,
though.
exactly.
Okay.
So I describe tax credits as the government giving you a gift card for your tax bill.
Right.
So essentially, if you owe $1,000 in taxes, but you've got a $50 tax credit, then you can essentially swipe that gift card and you've paid $50 worth of your $1,000 bill.
That's right. That's right.
Whereas a deduction is, and this is where I didn't quite get the vocabulary words right, but it's essentially it works the same way as the itemized or the standard.
That's
meaning
right.
It subtracts it from your income or what your income would. I'm losing it here.
Yeah,
basically what the government would consider your income.
Correct.
It's what you owe taxes on.
Yeah, it's correct. It's a deduction in arriving at your taxable income. So you get all your income items minus your standard deduction.
Yeah. So if you got thrown another $5,000 deduction for whatever reason, and you make $100,000, then it would be like, okay, boom, now I'm at 95.
You pay tax on 95. So let's take the example full circle. We started with tax brackets. So here's the question would be, okay, so $5,000, how does that affect my taxes? Well, you apply whatever tax bracket you're in. So let's just say at 95 example, that puts you in the 22% tax bracket. So some quick math, a $5,000 deduction at 22% saves you $1,100 because it's $5,000 less amount of income at 22%. So that's how you can start to think about deductions. They save you at whatever tax rate you're in. And you made a great example about the gift card. A credit is a reduction of the tax, like a direct reduction. So like lots of us here, you and I, we get child tax credits. That's just a credit. So say if your total tax bill, once you work through all the tax brackets and did the math, was $20,000. You've got 2 kids. They say, okay, Tyler, we'll give you a $2,000 credit per child, $4,000. Now your total tax is $16,000. Boom, just like that.
Gotcha.
So just a total reduction of your tax, and then you can get into refundable tax credits. That is a credit over and above your tax due, where they literally give you money back. And
yeah, and these are all the reasons you need a good CPA.
That's right. That's right. Yeah, just to understand this stuff, because, like I said, my goal when we started this podcast was to try to make some of these concepts a little more palatable, give people a little bit more knowledge, break the myths, kind of the old wives' tales about things like, if I go in a new tax bracket, does that mean all my money's taxed at that new rate? No.
Right.
If I form an LLC, does that mean I can deduct more expenses? No. Not in a bad way, but just that's the reason why we wanted to do this, just to give people some kind of understanding, like, okay, I don't have to understand all the ins and outs, but it will definitely help me manage my finances and my business.
Right, and I think you nailed it earlier with expectations.
Yeah.
I think as business owners, that's about all you could ask for is like taxes aren't going away, but the more you can anticipate and you have a good understanding of what to expect,
right,
the better you can run your business. And
what I tell my clients is all the time, I say, the more you know, the better client you are. Like because I can't read your mind. I can't, we reach out with newsletters and we, quarterly or different types of check-ins or depending upon the package you have with us. But if you know these concepts, sometimes you'll bring something to the table like, hey, I know I sold my business and I know that may or may not be capital gain. That's all you need to know. Or I had this event and I know, I'm probably moving up, going to pay a little bit higher rate this year. Again, you don't have to know that it's 24 or 22 or 32.
Right.
It's just issue recognition that you then call your CPA and said, hey man, this is going on. I think this is my expectation, but correct me. And then it starts a discussion and you get better service.
Gotcha. Well, on that note, we'll wrap it up. But if you do need a good CPA, or if this has prompted you to think, okay, I've had something like this happen, I sold a business, or, you just want to get a handle on these things and get the insider deductions, the latest.
the insider deductions.
Exactly, yeah.
I like that.
We should rename the podcast Insider Production Deductions. But anyway, go to mire.group.
Yep.
And we've got a pretty cool self-assessment there on where to start. It's based on the total control accounting system and this whole roadmap that you've built out on how to take people out of chaos in their accounting and into clarity. And that's a good place to start, I think, for any small business owner. So go to mire.group, check that out, take the self-assessment quiz. It'll take you 2 seconds, and it'll get you connected with the Mire Group CPAs. So on that end, we'll be here next week.
Until next time.
All right, thanks.